You invest $10,000 in a dividend growth stock. You do not touch it. You reinvest every single dividend payment back into more shares. 30 years later, that $10,000 has become between $200,000 and $580,000, depending on the stock you chose. Here is how it works. Year 1, $10,000 earns $260 in dividends at a 2.6% yield. You reinvest that $260. Year 2, $10,260 earns $270 because the company raised its dividend 5%. Year 5, $12,200 earns $380. Year 10, $17,500 earns $700. Year 20, $42,000 earns $2,400. By year 30, your $10,000 has grown to somewhere between $212 and $580, depending on total return. The snowball accelerates as it gets bigger. Two things are happening simultaneously. 1. Your share count is growing because every dividend payment buys more shares. 2. The dividend per share is growing because the company raises its dividend every year. These two forces compound on each other. More shares earning a higher dividend per share creates exponential growth. This double compounding is why the DRIP strategy is so powerful. The honest range. VD's 20-year average annual return is 10.85%. At that rate, 10,000 becomes 212. That is the realistic baseline. At 12%, 300. At 14.5%, which requires exceptional dividend growth plus capital appreciation, 580, the headline number. 580 is achievable with the right dividend growth stock held for 30 years. 212 is the realistic baseline. Both are life-changing from a $10,000 starting investment. In this video, DRIP mechanics and how reinvestment works. Broker side versus company side DRIPs. The fractional share game changer. The compounding math at 5 different yield levels. Dividend growth rate as the most powerful lever. Real company results from Coca-Cola, Johnson & Johnson, and Procter & Gamble. The high yield trap and why chasing 8% yields destroys wealth. Tax optimization with Roth IRAs. Portfolio scenarios at 10, 50, and 100,000 starting amounts. And the complete action plan for building a DRIP portfolio in 2026. Quick disclaimer, I am not a financial advisor. This is educational analysis of dividend reinvestment and compounding mathematics. Past performance does not guarantee future results. Dividends can be cut or eliminated. Consult a professional. Welcome back to Faceless Millionaire. DRIP is one of the most powerful wealth-building tools ever invented. But most people do not understand how it works or how to maximize it. Subscribe and let us build your snowball. What is a DRIP? Dividend Reinvestment Plan. Instead of receiving dividend cash in your checking account, you automatically buy more shares of the same stock with that dividend. Every dividend payment, more shares. Automatically, no effort. Without DRIP. You own 100 shares of Coca-Cola at $79.60. Quarterly dividend 53 cents per share equals $53 cash. Goes to your checking account. Sits there, earning nothing. After 30 years, still 100 shares plus $63.60 in collected cash. With DRIP, that same $53 buys 0.67 more shares of Coca-Cola automatically. After 1 year, 102.7 shares. After 5 years, approximately 114 shares. After 30 years, 300 to 400 plus shares, all earning dividends. The snowball builds itself. Broker side DRIP. Enable in your Fidelity or Schwab or Vanguard account settings. One toggle applies to all your holdings. Fractional shares included automatically. Free with no commissions. No transfer agents needed. Flexible because you can turn it on or off anytime. Company side DRIP, you enroll with each company's transfer agent individually. More hassle, same end result. No meaningful advantage for most investors. Use broker side DRIP. Fractional shares changed everything. Before 2019, A $53 dividend on a $79.60 stock bought 0 whole shares. $53 sat as uninvested cash. After 2019, when brokers added fractional shares, $53 buys exactly 0.6658 shares. Every penny compounds. Fractional shares eliminated cash leakage. Every dividend dollar is now fully invested. Over 30 years, this adds 10 to 15% more wealth compared to the old whole share-only system. The compounding math. The real numbers behind the snowball. Base case. $10,000 invested in Coca-Cola at its actual current yield of 2.6%. Dividend grows 5% annually. Stock appreciates 7% annually. Year 1, dividend $2.60, reinvested, stock appreciates 7%. End value $10,960. Year 2, dividend on $10,960 at 2.73% yield equals $2.99. End value $12,029. The total effective return is approximately 9.6% per year, combining the dividend yield and capital appreciation. 30-year projection. At 9.6%, 10,000 times 15.36 equals 153,600. At 10.85, which is VT's 20-year average, 10,000 times 20, 1.2 equals 212,000. At 12%, 10,000 times 30 equals 300,000. At 14.5, which is aggressive and requires exceptional stock selection, 10,000 times 58 equals 580,000. The headline number of 580 requires the top tier of performance. The realistic range is 150 to 300,000. 5 yield scenarios, all starting with 10,000 over 30 years. 2% yield with 12% total return, including capital appreciation, 300,000. 3% yield with 11% total return, 228. 4% yield with 10% total, 174. 5% yield with 8% total, 101. 6% yield with 7% total, 76,000. The pattern is unmistakable. Lower yield with higher growth wins. Higher yield with lower growth loses. The 6% yield stock ends at 76,000. The 2% yield stock ends at 300,000. 4 times more wealth from the lower yielding stock. Why does lower yield win? Because total return is what compounds, not yield alone. A 2% yield stock typically grows 10% plus per year. Think tech-adjacent dividend growers like Apple or Microsoft. A 6% yield stock typically grows 1 to 2% per year. Think mature utilities and REITs. The growth rate is the engine that drives the compounding machine. The yield is just the fuel. High-octane growth fuel beats high-volume low-octane fuel every time over 30 years. Dividend growth rate, the most powerful lever in the entire DRIP strategy. Same 3% starting yield, but different growth rates. 3% dividend growth plus 3% capital appreciation equals 9% total. 10,000 becomes 133,000. 5% dividend growth plus 5 capital equals 13 total. 10,000 becomes 390,000. 7% both equals 17 total. 10,000 becomes 1.1 million. Every 2% higher in growth rate produces roughly 3 times more wealth over 30 years. Growth rate is everything. Yield is secondary. Historical dividend growth from verified data. Coca-Cola, 3-year growth 5%, 5-year 4.5, 10-year 4.4. Consistent mid-single digits for decades. Johnson & Johnson, recent growth approximately 4.4%, payout ratio 60%, which is healthy. Procter & Gamble, 68 consecutive years of increases, growing 5 to 6% annually. STI 3-year dividend growth, 11.5%, but that is volatile and driven by annual rebalancing effects. Apple started dividends in 2012, growing 5 to 6% annually since. Real DRIP results from actual history. Coca-Cola invested in 1996, 10,000. DRIP active for 30 years to 2026, approximately 100 to 130,000, including all dividend reinvestment. Johnson & Johnson same period, approximately 120 to 160 due to stronger capital appreciation. VTI Total Market Index, 10,000 in 1996, approximately 200,000 plus by 2026. Coca-Cola and Johnson & Johnson DRIP results are real but actually less than VTI Total Market over this specific period. Individual dividend stocks underperform the broad index. That is an important, honest caveat. Why individual dividend stocks sometimes underperform the index. Coca-Cola in 1998 was extremely overvalued at a price-to-earnings ratio above 40. Buying at a high valuation limits future returns regardless of dividend quality. Johnson & Johnson faced litigation headwinds that weighed on the stock price. Meanwhile, VTI includes tech giants like Apple, Microsoft, and Nvidia that drove enormous index returns. DRIP works best when you buy at reasonable valuations. The right stock at the wrong price still underperforms. Valuation matters. Time horizon breakdown on 10,000 at VTI 20-year average of 10.85%. 5 years, 16,700, a 67% gain, not exciting. 10 years, 28,000, 180%, noticeable. 15 years, 46,800, 368% getting serious. 20 years, 78,300, 683% meaningful wealth. 25 years, 131,000, 10%. Impressive, 30 years, 212,000, 20% life-changing. Each 5-year increment adds more dollars than the previous one. That is exponential growth in action. The critical insight. Years 20 to 30 generate more wealth than years 1 to 20 combined. Years 1 through 20, 10,000 grows to 78, adding 68,000. Years 21 through 30, 78 grows to 212, adding 134,000. The last decade produces double the wealth of the first 2 decades combined. This is why quitting at year 15 is so costly. You miss the exponential acceleration phase where compounding becomes truly powerful. The dividend snowball visualization. Year 1, 260 annual dividend, a tiny snowball barely rolling. Year 5, 380, slightly bigger. Year 10, 700, noticeable momentum. Year 15, 1200, rolling downhill. Year 20, 2400, accelerating visibly. Year 25, 4500, massive and fast. Year 30, 8,000 plus, unstoppable. The growth accelerates every single year because both your share count and the dividend per share are growing simultaneously. 2 engines of growth compounding on each other. The high yield trap. Why chasing 8% yields destroys long-term wealth. The temptation. Stock A yields 7%. Stock B yields 2.5. Stock A seems obviously better. But run the math. Stock A, 7% yield, 0 growth, 0 capital appreciation. 10,000 at 7% for 30 years equals 76,000. Stock B, 2.5% yield, 5% dividend growth, 7% capital appreciation. 10,000 at 14.5% for 30 years equals 580,000. Stock B wins by 504,000. 762% more wealth from the lower yielding stock. The high yield was a trap. Why high yield stocks have low growth. Companies paying out 80 to 90% of earnings as dividends have no money left to reinvest in the business. No reinvestment means no growth. No growth means stagnant stock price. Stagnant stock price means the only return is the dividend yield. High payout ratio is the mechanism of the trap. The company pays you more today by sacrificing its own future growth. You feel rich from the income checks while your total wealth barely moves. Honest caveat about Coca-Cola. Co's payout ratio is currently 80%. This is higher than the 40 to 70% safe range I recommend. Co survives at 80% because it has an extremely stable business model with global brand dominance and pricing power. But 80% payout plus 4.5% dividend growth means Coca-Cola is near its sustainable ceiling for dividend increases. Co at 80% payout is the exception, not the rule. Most stocks operating at 80% plus payout are traps heading toward a dividend cut. Red flags signaling a potential dividend cut. Payout ratio above 80%, which is unsustainable for most companies. Dividend growing faster than earnings, meaning the company is paying out more than it earns. Stock price declining while yield rises, which means the yield is inflated by a falling price, not a rising dividend. Industry disruption like telecom or legacy energy where the business model is under threat. Rising debt to fund dividends, meaning the company is borrowing money to pay shareholders. And less than 10 years of consistent dividend history, meaning no proven track record through recessions. Green flags for safe drip candidates. Payout ratio 40 to 70%, leaving room for both dividends and reinvestment. Dividend and earnings growing at similar rates of 4 to 7% both. Stock price appreciating 5% plus annually, showing a healthy business. Stable industry like consumer staples or healthcare. Debt stable or declining, showing financial discipline. 25 plus years of consecutive dividend increases, qualifying as a dividend aristocrat. And a reasonable price to earnings ratio under 25, so you are not overpaying. Case study, General Electric, the trap. 2010, 3% yield, looks safe as a dividend stock. 2018, dividend cut 50%. 2020, cut another 50%. Drip investors were reinvesting dividends into a sinking ship the entire time. 10,000 became approximately 5,000. Contrast with Johnson & Johnson, the safe choice. 54 years of consecutive increases. Never cut the dividend. Payout ratio 60%, which is sustainable. 10,000 in drip from 1996, approximately 120 to 160,000. The right stock makes all the difference. Real portfolio scenarios at 3 different starting amounts. And the critical tax optimization that can add hundreds of thousands in wealth. 10,000 at VTI average, 10.85 for 30 years, 212 pre-tax. In a taxable account with 15% qualified dividend tax plus capital gains, approximately 180 after tax. In traditional IRA, 212 pre-tax, approximately 160 after tax on withdrawal at ordinary income rates. In Roth IRA, 212 entirely tax-free. Roth Advantage, 32 to 52,000 more than taxable or traditional. Same investment, different location, massive difference. 50,000 starting amount. VIDI average for 30 years, 50,000 times 21.2 equals 1.06 million pre-tax. In taxable account, approximately 900,000 after tax. Traditional IRA, approximately 800,000 after tax depending on withdrawal strategy. Roth, 1.06 million entirely tax-free. Roth Advantage on 50,000, 160 to 260,000 more wealth over 30 years. Account location is arguably more important than stock selection. 100,000 starting amount. VT average for 30 years equals 2.12 million pre-tax. Taxable, approximately 1.8 million after tax. Traditional, approximately 1.6 million after tax. Roth, 2.12 million entirely tax-free. Roth Advantage, 320 to 520,000. On 100,000, choosing Roth over taxable saves you up to 520,000. That is a $500,000 tax decision made at the moment you open the account. Tax priority order. 1. Max your Roth IRA at $7,500 per year or $8,500 if you are 50 or older. 2. Max your 401k match to get the free employer money. 3. If you are a high earner above the Roth income phase-out, which is $153,000 to $168,000 for single filers in 2026. Use the backdoor Roth conversion. 4. Traditional IRA and 401k for additional tax-deferred space. 5. Taxable account as last resort for drip money. Every dollar in a Roth grows tax-free forever. Prioritize Roth above everything else for your drip strategy. Why qualified dividends matter for drip? Coca-Cola, Johnson & Johnson, and Procter & Gamble all pay qualified dividends taxed at 0, 15, or 20%. REITs pay non-qualified dividends taxed as ordinary income at rates up to 37%. 100,000 drip in qualified dividend stock versus REIT over 30 years. Qualified stock approximately $1.8 million after tax. REIT approximately $1 million after tax. Qualified dividends save $800,000 versus REIT dividends over 30 years. Stock selection directly affects tax treatment and after-tax wealth. Drip versus lump sum investing. Who comes out ahead over 30 years? Drip is automatic dollar cost averaging. Each dividend reinvestment buys shares at whatever the current price is on payment day. If the stock drops, your dividend buys more shares, automatically buying on dips. If the stock rises, your dividend buys fewer shares. Over time, you get a better average purchase price in volatile markets. You do not have to think about timing. The system does it for you. Historical research from Vanguard. Lump sum investing wins 67% of the time by 3 to 8% outperformance because the market goes up more often than down, and having money in earlier means more compounding time. Dollar cost averaging through drip wins 33% of the time, typically by 10 to 15% in crash scenarios where you buy heavily at low prices. Best approach? Hybrid. Invest your available lump sum immediately. Enable drip on all positions. Then add monthly contributions from your salary. This combines the advantages of both strategies. Hybrid example, 20,000 lump sum into sheet on day 1. Drip enabled. 300 per month added from salary. Total invested over 30 years, 20,000 plus 300 times 360 months equals 128,000 of your own money. At 10.85% average, 128,000 invested grows to approximately 2 to 3 million. 128,000 of your own money becomes 2 to 3 million. This is realistic wealth building for ordinary people with ordinary incomes. Your action plan. Week 1. Screen 3 to 5 dividend aristocrats like Coca-Cola, Johnson & Johnson, Procter & Gamble, or simply use the SHADE ETF for instant diversification. Run each through the green flag checklist. Week 2. Open or fund your Fidelity or Schwab or Vanguard account. Buy shares. Week 3. Enable drip in your account settings, which takes 5 minutes. Set up $200 to $500 per month in automatic investing from your paycheck. Done your one annual task. 15 minutes to verify your companies did not cut their dividend. That is the entire system. Simple, boring, and extraordinarily powerful over 30 years. What not to do. Do not check stock prices daily because it causes panic selling. Do not sell during market crashes because it breaks the snowball. Do not chase higher yielding stocks because most are traps. Do not switch strategies mid-game because consistency wins over optimization. Do not try to time the market because you will get it wrong. Discipline is 90% of drip success. Stock selection is 10%. Boring wins. The people who build wealth through drip are not the smartest investors. They are the most patient. Who should drip? Age 25 to 45 accumulators with a 20 to 35-year horizon, strong yes. Age 45 to 55 pre-retirees with 15 to 25 years, yes with a transition plan to start withdrawing dividends closer to retirement. Age 60 plus retirees, yes with a hybrid approach, reinvesting half the dividends and withdrawing half for income. Monthly savers with 2 to 500 per month, strong yes, set up auto invest plus drip and let time do the work. Anyone with Roth IRA contribution space available? Strong yes. Maximize tax-free compounding. Who should not drip? Time horizon under 5 years because there is not enough time for compounding to overcome volatility. People who need income right now because reinvesting defeats the purpose. Active traders because drip requires patience they do not have. And high earners who can only invest in taxable accounts with no Roth access because the tax drag is severe. If you need the money in 5 years, drip is the wrong tool. Use money market accounts or CDs instead. Realistic expectations. First decade, slow growth, 10,000 to 28. Second decade, solid, 28 to 78. Third decade, life-changing, 78 to 212. Most people quit before year 20 because years 1 through 15 feel painfully slow. You check your account and see 10,000 has become 20,000 after 6 years. That does not feel like a snowball. It feels like watching paint dry, but the winners are the ones who endure the boring years. The snowball only becomes unstoppable if you let it roll for 25 to 30 years. 10,000 invested with drip for 30 years. Realistic range 150 to 580, depending on stock selection and total return. 128,000 invested through a combination of 20,000 lump sum plus 300 per month. All with drip for 30 years, 2 to 3 million. The math is real. The discipline is the hard part. Boring now, life-changing later. Start your snowball today. Drip turns dividends into compound growth. The snowball starts small and becomes unstoppable. Drop your age, your starting amount, and your favorite dividend stock in the comments. I will run the 30-year projection for you. Hit subscribe. See you next week. Full disclaimer. This video is for educational purposes only. Nothing constitutes financial or investment advice. All projections use historical averages and mathematical assumptions. VT 20-year average 10.85%. Individual stock returns vary significantly. The headline 580 requires 14.5% annual return for 30 years, which is above the market average and requires exceptional stock selection. Realistic range for most investors is 150 to 300,000 on 10,000 invested. Coca-Cola yield 2.6%, payout ratio 80%. Johnson & Johnson yield 2.2%, payout ratio 60%. Procter & Gamble approximately 2.4% yield. All verified June 2026. Dividend yields, growth rates, and payout ratios change constantly. Dividends can be cut or eliminated even by companies with long histories. Past dividend growth does not guarantee future increases. Tax analysis uses 2026 federal rates. Qualified dividend rates of 0, 15, and 20%. Roth IRA contribution limit $7,500 per year. State taxes vary and are not included. Tax loss harvesting and backdoor Roth strategies have specific EARS rules. Consult a CPA or tax professional for your specific situation. Compounding requires time, patience, and discipline. Market crashes happen and are part of the process. Do not invest money you need within 5 years. DRIP is a long-term strategy for patient investors. Short-term traders and those needing immediate income should use different approaches. Consult a financial advisor before investing. Thanks for watching.